Hey everybody, it's been a while. I've been very busy with a lot of things, and I've had to take some time to sort of catch up with things and think about things. And yeah, I didn't feel comfortable making a video if I didn't feel a little bit acclimated to like economics and politics and things like that. I've always kind of kept up with things here and there, but yeah, I was working like, I don't know, 50 to 70 hours a week. So, I was extremely busy, and I just felt like it wouldn't have been fair to make a video um, or share my opinion on things if I wasn't at least somewhat certain on things, or at least had some conviction towards my thoughts. Anyway, so none of this is financial advice. Please do your own research. Everything I've said in this video, everything I've ever said, is just a joke. I can be wrong. I've probably been more wrong than right ever, and my views are constantly changing because, well, I'm getting more information every day, and my opinions are constantly changing as well as they need to be changed. So in this video, I'm just gonna be sharing my general thoughts and views on things. This is all unstructured. I'm just going to be sharing my opinions on things, which can be completely wrong. So don't take this seriously. None of this is financial advice. This is just a joke. Don't take it seriously, okay? So I honestly don't know where to start, mainly because it's been so long since I made a video, and I've been so busy that, well, I feel like there's a lot of things I would like to talk about, but I just have no direction, honestly. So I guess I'll just be taking my time and yeah, just sharing my views on things as they come up. So I have a few things that I pulled up here, mainly because, well, these are the only things I can really think about, and I'll share my opinions on each one. So let's start with let's start with the interest rates, the Fed interest rates, okay? So when I'm looking at this, as I've said in other videos, I always find it interesting that generally interest rates drop dramatically once something breaks in the economy. So there's some kind of unforeseen problem, or there's problems that people aren't really aware of. But as someone who predicted the market crash of 2020, due to the the pandemic, right? I did predict the market crash here. At the time, I remember speaking to one of my university professors about in December that I saw a market crash coming. I was telling my friends in 2019 that I foresaw a market crash coming, and I did have some put options on a few companies like Marriott, for example. I also did really well on a few companies at that time, but yeah, there was a lot of indicators to me that felt like there was going to be a market crash, and I ended up being right. I have proof, so if you want any proof of this, feel free to leave a comment below, and I'll be glad to share some evidence, maybe on my next video or something, that I did predict the market crash of 2020. And but the most important thing is that I understood that there's economic problems. I was in the industry that I was working in. I just saw that despite the high demand and the economy being superheated at the time, at least in my industry, I felt like despite all that, there's just so many issues. So yeah, despite believing that people would think, oh, we have the strongest economy or whatever, things like that, I had known that we had underlying economic issues with, well, yeah, just our financial markets, and yeah, just in general. I don't really want to talk about that too much, but yeah, well, I guess I could share. During that time, I felt that despite the economy running hot, I remember feeling that things weren't right. Okay, so I remember looking at the company balance sheets and thinking, well, I understand that we're going to need lower interest rates to be able to keep up these numbers, and that you can inflate a lot of these numbers that if you want to have good earnings and things like that. But company balance sheets in general on a global basis just weren't doing too well relative to things like inflation or like real value. And yeah, I mean, I would say that we had like a 80 to 100% ish, like, I don't know, amount of demand. But yeah, I just felt the strain, on the real economy, that it was kind of like the problems we see today, but different, right? So, yeah. I mean, today now the demand side will be like 30 to 20 to 40% ish. And it's slowly picking up because Q4 and Q3 generally do pretty well for the industry I'm working in, or I was working in. But everything pointed to me that things weren't going too well. And it's interesting, yeah, because like I feel like there's a lot of the similar problems today, but it's just that instead of having like the high demand for things, the demand side has been crushed. So yeah, I don't want to get into that too much, mainly because I feel like that's something you'd have to be really I feel like that's going to take a lot of time and energy to speak about. But yeah, so I always find it interesting that you know generally when we have interest rates lowering down, something crazy happens or something dramatic happens, right? So you can have something occur here, and I can't say if it's manufactured or not, right? I can't say that there wasn't institutions or governments that were willing to capitalize on it, or that we had a trade deal between the United States and China at the time that maybe things did or didn't work out. But to analyze these things is a big topic on its own, right? Like you could talk about did this time, right? I don't want to say the word because I don't want to be yeah. But yeah, during this time, did things work out in China and the United States' favor? And honestly, yeah, I would say that things turned out pretty well for them in a weird way. So I think a lot of the things we see today between the United States, China, and global economics and politics will eventually, in the long run, become more. It'll become more obvious. It'll become more like how we view it today might change drastically. Like a lot of the things we see today is political theater, but how we view it in a year or 6 months from now can change dramatically once we have a new perspective on things, right? So one of the things I've been thinking about recently is the United States and China. There seems to be a lot of tension in the media about these two countries, but honestly, I don't really see it. I think these countries are best friends. If you really ask me, I think these countries are probably going to be best friends. And I could talk about how to view things like capital flows, or maybe I could talk about political theater versus like things like that, or Trump going to APEC today and this week and meeting with Xi Jinping. But there's always conversations backdoor that are constantly happening. So political theater, right? But I don't really want to go into that. But my whole to kind of summarize everything, I think that the United States and China are good friends. Like there's just nothing really convincing that says otherwise. Like I know there's a lot of political theater and saber rattling, but that's not really convincing me that these countries are enemies. And yeah, so I think maybe I'll make a video on that. But I feel a little bad to talk about that, mainly because I think that deserves a lot of time and research. But I can't really do that right now. Maybe one day I would love to do that, but not right now. So Will something happen that encourages the Fed to lower interest rates dramatically? Hmm. Um, yeah, and I do have opinions on like what would happen in that scenario. So, ideally, what I would prefer mostly is that you have Chinese firms moving to the United States, forming joint ventures or partnerships similar to like Japanese foreign investments into the United States, opening up factories, revitalizing economies, building up infrastructure, revitalizing canals, things like that. um, and then balancing like revenue streams, right? So like, if the United States opens up a BYD factory in like the Middle East, not Middle East, but like the Mid East of the United States, then we can revitalize the economy. We can shift a lot of our agriculture and accommodations to economy to accommodate that. And you're gonna have to make a lot of economic reformations and structural changes, but I think in the long run it would be pretty good for both countries and the global society, because overall the demand side from the global economy will increase. So it allows for other countries that really need resources and investments to start production again at a higher rate. But yeah, that's something I don't really want to get too much into. Maybe one day I will. Maybe in my next video, I'll do that. This is a very unstructured video. I just want to share my opinion, so we'll see. And I wonder if we lower interest rates and borrowing cost becomes cheaper. I've noticed that recently, well, not recently, but yeah, under these conditions, private lenders have been much more. Well, private lenders in general seem to be much more lenient on things, and the way they structure things is like, they can do things like loan to owns or like lend money or credit at very unfavorable conditions for distressed companies. And these distressed companies could really benefit from lower interest rates and removing tariffs and or reducing them tremendously. And there's just a lot of these American companies right now that could really benefit from it. So it makes me wonder. Oh yeah, you can just. I wonder if there's something to look at more, right? I have some investments in some of these types of things, and it turned out pretty good actually. So we'll see how things go. But yeah, lowering rates could be a good thing for a lot of these distressed companies. Especially since when I look at things, it looks like a lot of these are going to go bankrupt, or they already have been. And yeah, I can understand a few of them, right? Like when you really think about the companies that have been filing bankruptcy, right? Whether they've been listed on the Nasdaq or the stock market or not, like small businesses to even larger businesses that are going bankrupt. Yeah, it makes sense that you want to weed out some of the bad companies, but wow, some of them, like you have to really think like, is it beneficial for the country if some of these do go bankrupt? Like, probably not. So the ones that have lasted this long, it kind of seems from what I've seen, so right as of now, is that they're just trying to stay alive until maybe maybe they would benefit from like lower tariffs and like lower borrowing costs, for example. So yeah, that is something to consider, I think. So another thing I would think about too is that with the AI bubble, like if borrowing costs become lower, would the AI bubble deflate? Would it grow in a much slower rate? And or would money move out from the AI bubble into assets that are seen as like higher risk, right? I mean, to me, like, I would assume that most firms would think this, but when you consider like high risk, right? You can look at the AI bubble and a lot of these bubbles and Mag 7s and all this stuff, you can look at a lot of the American tech companies that are doing really well despite high valuations, that they're a necessity, right? Almost like a UBI in a sense, but not really. Like home values that keep appreciating in general, or like or like equities that have done really well. A lot of times they almost act like a universal basic income for like a certain demographic of people, right? It allows for like some it allows for like some form of UBI, like like a stimulus almost through the financial markets. And you know, I understand that these companies, they have a purpose, right? So it's not just like their earnings in general. The purpose of them is to keep our economy propped up. So it's kind of risky to like bet against them, mainly because even if you might think that there's a lot of foreign stocks or like United States assets and stocks that are like undervalued right now, and you may want to like bet against the AI bubble. The purpose of the AI bubble is kind of like Tesla back in the day. It has much more. Well, like it props up the demand side, right? You know, it creates a lot of like the wealth effect. So, yeah, you know, I wonder if borrowing costs become even lower and tariffs are reduced as well. Even if those companies like Nvidia report better earnings, and they can actually meet their forecasts or even beat forecasts, I would still wonder if like they would maybe either deflate slowly or money would move out into like other companies, and investors are going to seek higher return on investment. So I mean, we can take a look at this then. I really don't like doing this, mainly because I'm already unstructured, so I'm just going to keep going on tangents, but we'll just do this. Okay, so let's take a look at this company right here, Nvidia. So this is part of the AI bubble, right? Let's see, we'll try this one as well. I guess you can consider this part of it. So Nvidia has a very Nvidia pretty much, along with a few like the Mag 7 and things like that, really carry the stock market. If you destroy the stock market, it destroys people's like pensions, retirement funds, the wealth effect, and things like that, which would crush the demand side. You know, when I was managing a business, maybe this year, I noticed that the demand side was like, I don't know, 20 to 40% from Q1 to Q2 ish, sort of. And you know, even if it's different from like 2019, where the demand side was like 80 to 100%, you know, what I've noticed is that, you know, it's generally propped up by people who are benefiting from the stock market and asset bubbles that we currently have. I mean, to me, ideally, if you have lower interest rates and lower tariffs, you kind of want money to move out of these kind of companies, right? Like Microsoft, Nvidia, Apple, and things like that. And you want it to go towards like companies that are distressed, like, your micros, your medium caps, your even other large caps that have been not doing too well but could really benefit from more capital inflows. You generally want your resources to go towards that, right? So let's just pretend that the Federal Reserve did lower interest rates and all the money went into the AI bubble. That's terrible. That's really bad for the economy. You're definitely going to kill the middle class even more. So ideally what you want is that you want to deflate the AI bubble, or at least make the growth of the AI bubble a little bit slower. I mean, this is a little ridiculous, right? And just speaking from like an economics point of view, like if you had slower growth at a more modest rate, it's not a bad thing. You can have this purposed to like prop up the economy, but you can also, firms in the private sector could be encouraged to slow down the growth in these types of, in the AI bubble, for example, and then have money move into like industrials or smaller tech companies or things like that. And a lot of companies will benefit from lower tariffs. So I wonder if we lower rates and if Trump works out a deal with China, if we could see that AI bubble deflate or slow down tremendously. You know, it's not a bad idea to have a pullback in the AI bubble, and then maybe try again, see if you can have like maybe the government or Fed can encourage a market crash or a market correction, like a larger one, and maybe at that point you have lower tariffs on China and you have lower interest rates, so capital flow into like other companies, right? So the Russell doesn't really represent everything, but it's just a general idea. So rather than money just flow into like these types of companies, you'll have it flow into like small cap, medium caps, and micro caps that really could benefit from it, that have lasted this long. I mean, if the companies have lasted this long, it means that they weren't. I mean, they must not be too bad, right? I mean, yeah, a lot of them needed access to cheap capital, right? But some of them are not too bad. They just need time. So you would wonder if, like, I don't know, you can find instances where like some companies have been around for like 40 years or something, and they just needed it's just that it was a rough time given the global market dynamics and the interest rates, and having to shift production because of tariffs and global dynamics. But yeah, maybe ideally you'd want the AI bubble to deflate and then have resources spread amongst like the whole economy. I could see that happening. I think my main question would be is if we'll see a market correction, or will we see this kind of bubble just slow down in growth, right? Just slow down, but the overall money supply increases. So the AI bubble just grows at a slower rate, like much slower. And then you see money move into other assets as well, where that you can see larger changes in the real economy that does help the lower and middle class. It would be interesting to see, like this is an example. I mean, this is really extreme, but this would be an example. So we can look at Cisco stock. I'm not saying Cisco is the same as Nvidia though, okay? But I am saying that in the .com bubble, you had large tech internet bubbles and tech bubbles like this, and then you had a slow growth, right? Well, sort of slow, right? Sort of. But without looking at this right here, the peak, when you look at this modest, or not modest, but slow growth, it's not too bad. And it's definitely something that is a little bit more stable for the economy. Because when you have AI bubbles and tech bubbles, it just creates such a huge wealth effect that's really going to hurt the economy. Okay, so yeah, I would wonder if you are the government and Fed, would you want to crash this bubble like a Cisco? And if you were to do so, you may have to lower tariffs, and you may have to make a trade deal. Yeah, I mean, it would be pretty brutal if you were to. Yeah, it would be really brutal. Let's just pretend this is Nvidia and the AI bubble. It'd be really, really brutal if, there's a lot of traders and investors who think, well, lower rates and lower tariffs means that my AI bubble stocks will do really, really well because they'll beat forecast, right? And that's true, they could, but if they're already priced at really high premiums or high valuations, then that may not really matter. And so this year alone, Nvidia has gone up 44%. It has a market cap of 4.9D. If there is going to be easy money policies, if borrowing costs are cheaper, if tariffs are lowered, will firms really want to gamble on a $5 trillion almost company doubling? Will they really gamble on that? Or will they will they take profits, or move out slowly, or rebalance portfolios to take on things like the Hang Seng, right? Like Chinese companies, or things in the Russell, or a lot of companies that will benefit heavily from lower borrowing costs and lower tariffs. Because I'm just going to say, for me personally, I've done pretty well this year. And I didn't touch the AI bubble, okay? I think personally, if I were a firm, right? If I were running my own firm, let's just say I bought Nvidia here, anytime here, okay? You know what I would do? I would be taking profits, and I'd be reinvesting it into the Hang Seng, into some United States small caps and medium caps and micro caps. And I may have some puts against this Nvidia, because, well, I've done such a great job, and I'll let like a very small amount ride. I mean, this is what I've been doing with one of my big winners this year, which is ZEP. So with this company, I bought here. Okay, I've been buying ZEP. I've been following this company for a long time because I follow Chinese companies, but I bought a lot here because I thought the company overall was pretty good. At these prices, I thought it was very attractive, and I did really well. But I definitely took profits along the way, and I ended up moving those profits into other companies, like what's one stock I was looking at? I put some in this stock, NIU, New Technologies, because to me it's a pretty good gamble when you have the markets the way that they are. And I have a list of other companies that I've done as well, but I don't really, that's not my point, right? The point I'm trying to make is that institutions and firms, they want to make their return on investment, and they want to maximize their profits. This, to me, Nvidia, is a really high risk, low reward company, because I just don't see a almost $5 trillion company really bringing me that many good returns compared to a lot of other companies that could benefit from lower rates and lower tariffs, or just lower rates. Even if tariffs stayed the same, like, there's just so many companies that would benefit from lower borrowing costs. So I actually think that a lot of firms are going to be pulling out of the AI bubble, or at least taking profits, and then moving into other industries where there's just much lower risk but higher reward. So some people might look at this as stable, but for me personally, I don't. I think this is very scary, because this isn't just about a stock. This is about what it's doing to the economy. So the AI bubble is actually very harmful for the economy, in my opinion. Yes, it's creating the wealth effect, yes, and that's not too bad if you want to stimulate the economy, but it's not good if you want to promote capital to flow into other sectors that could really benefit from it. Of course, you can do it creatively too, right? So like if you want to prop up like a certain age demographic, so let's look at 65 and over is 18%, 45 to 64 is 25%. Okay. So, that's not it. Wow, this is actually very interesting. We can take a look at this one day. Okay, I guess this is 2020. So, if the way the AI bubble is currently, and housing bubble and all these other bubbles are currently propping up this portion of the economy, and a little bit of this, little bit, very little bit, but also making it much harder for this demographic. The demographic that the retired demographic, the baby boomers and things like that, this is a big deal, right? This large portion right here. So, I don't know how the government can do this, but if the government and Fed could somehow prop up the AI bubble and the S&P 500 and things like that, and the Social Security and pension funds, all this sort of thing, without popping it too much, like what we saw in the past 5 years or so, you could kind of have this demographic, the baby boomers, you can have this, you could part of the economy stimulated through the private sector, through the AI bubble and other bubbles and things like that, and the housing bubble and stuff. You can have that, but this lower half right here takes on the full burden of propping up all these asset bubbles. And how you look at the AI bubble is like, it's a lot of it could be because of the protectionist policies and the high interest rates relative to what we've had in the past 10 years. But if you can bring, if the United States and China can arrange some kind of trade deal where I think it was like a $1 trillion if you can bring foreign direct investments from large countries like China into the United States, then maybe you can help this demographic out a lot too, because bringing Chinese investments, bringing Chinese services and goods, that's deflationary, and you can also increase job opportunities and production and economic growth by lowering rates and lowering tariffs. So you can have the AI bubble or whatever bubble you have, the Eve bubble, whatever, prop up this demographic as a UBI, and then use foreign direct investments and lower tariffs to help the real economy out, the working class. And then you can also create more jobs, and cost of living can go down. So I think that's going to be arranged over time. I think a lot of the stuff we see is promoting structural changes that are helping this occur. So but yeah, so I mean, again, I think firms are definitely going to want to take out money from this and then start investing in other companies as well that haven't benefited. So let's think of an example of a company that hasn't benefited. Okay, let's take a look at iRobot. Yeah, I think this is one of the common examples of a lot of the American companies that are in the same very, very similar predicament. Okay, so with iRobot, for example, this company could probably benefit from lower interest rates, lower tariffs, because I think this company, it used to do pretty well. It used to be one of the leaders in its time I think a lot of the manufacturing of its products were in China and Asia and relied heavily on Asian supply chains, but I think a lot of like the research and development was done in America or something of that nature. The tariffs definitely negatively impacted this company a lot because I think that this company had to move a lot of its production from China to like Malaysia. Um, so, could this company that I think is borrowing money from Carlyle right now, like Hertz, um, could they benefit from lower rates and lower tariffs? Yeah, I think their profit margins would increase tremendously, and investors may want to take on more risk. So if they take profit from Nvidia, for example, or the AI bubble, they might think, well, this could possibly give me a high return on my investment. So this might be viewed as high risk, high reward, despite it acting as a UBI or social security system or social, yeah, SSI in a sense, right? Until it's not, right? Another one too could be like Kane's brand. Um, I think I don't know how much production was done and where, but could this company borrow from lower borrowing cost and just more increased global demand? Yeah. Um, especially if they have debt, right? They can. I think this company was heavily in debt, which is why they had to remove their dividends. Haynes, for example. So, they could definitely benefit from reducing tariffs, for example, and having a more productive economy, because the global economy means, well, more demand for its stuff, right? So, yeah, lowering interest rates and lowering tariffs is just good for the overall global economy. So, yeah. Um, so that's one thing that could benefit everybody on a global basis, at least in the United States, right? I can't say like, okay, if you have lower borrowing costs, yeah, I'm sure it can benefit a lot of countries too, like emerging economies and third world and second world countries. But then like tariffs have benefited some countries too, right? So like it did promote China to offshore a lot of its manufacturing to places like Vietnam, for example. But at the same time, it's like, well, it's all about an individual basis case scenario, right? Like, did all the companies that were offshored from China to Vietnam or other parts to or Malaysia to were they all to avoid tariffs, or was it just more cost efficient that way because the wages in China has risen as well, right? So it's all like, well, you have to look at things by case by case scenario. But yeah, so lowering interest rates, lowering tariffs can generally help the United States a lot, in my opinion. But yeah, the Rust Belt, it could definitely, well, there is a lot of problems going on with the Rust Belt, and the Rust Belt could definitely benefit from lower interest rates, and if done properly, right? You would have to have like a lot of foreign direct investments to help out this area. I mean, there's a lot of canals here, so if you do have production here, right? If you change agriculture from like soy beans to domestic consumption and foreign and exports as well, but you cater towards like domestic consumption, well, if you bring foreign direct investments into this side, like to bring like to promote electric vehicle manufacturing, for example, and you sell it from like east to west, um, you have a lot of the Great Lakes here, which has a lot of canals and things like that, and you can transport a lot of these vehicles through rail systems or through canals and other goods and supplies and things like that. So yeah, if you really want to revitalize the economy here, or the United States in general, you need more foreign direct investments, and China is going to be one of the biggest ones ever, one of the biggest investments ever. Well, also, one of the best things about doing that too is that if you were to open up a BYD factory in Michigan, for example, well, if you have supply chains like Nippon Steel, and Japan can benefit from that too because it's part of the supply chain now. Um, at least if you want to revitalize the Rust Belt, where a lot of the opium addiction that Trump blames on China, for example, is because of, well, it's poor management, but also maybe it's like maybe there's a lot of other things too, right? Like economic issues, right? He could be alluding to economic issues or something. You could have the canals be revitalized, and like a lot of the shipping canals, or like farms can be repurposed, or small towns that have been decimated by like migration, outside emigration or displacement, to really help these areas out. And you can do that through foreign direct investments. So yeah, we'll see how that goes. Oh my god, I just keep going on and on. I think it's because like I'm just talking about whatever's on the top of my head. Hold on, I have to use the bathroom real quick. Okay, so yeah, I guess, I guess I just, I guess I did have a lot of things in my mind that I just kind of never really had the time to really talk about it with anyone. So yeah, um, so that's one thing. But I don't really want to talk about this too much, mainly because these all things that they deserve. Well, they deserve my focus and attention, but they also deserve a better explanation. So, but yeah, so a lot of these kind of companies are, I would say, distressed, right? And they can generally benefit from lower interest rates and reducing tariffs. But again, a lot of it's very situational too. But these are two examples. So, if I were a firm, I may want to do that. For example, I may want to take away from my. I would take profits from things that have done really well, and I would invest in companies that haven't been doing so well. So verification. I mean, even this company too. Like, generally during good times when the overall economy is doing good, and there's not as much trade barriers, and there is lower borrowing cost, and there isn't sanctions and tariffs everywhere, and the consumer is feeling really confident globally. These types of companies like Marriott Vacations Worldwide do pretty well because, well, you have a lot of tourism, right? But the declining stock price, its poor earnings, could be because that the global it's a reflection of the global economy, right? So a lot of these hospitality and tourism stocks, they can really reflect like the position of the how like the sentiment of the global consumer, how they feel, how confident they are. So yeah, not looking too good from a year basis, from a 5 year as well. But you know, could I expect this thing to go up if tariffs are lowered? Yeah, because a company like a lot of these hotels or vacation clubs, all these types of things, right? One is that they rely heavily on tourism and travel. So the higher occupancy they have, the more demand that they have for their rooms, the better pricing power that these companies have. So they can increase their rates at their hotels or vacation clubs. Lower tariffs means that they can reduce the cost of their operations. So things like their soaps, their shampoos, their linen, things like that go down in price a lot. And so their profit margins are generally much higher. This can be reflecting the fact that tariffs are negatively impacting its operation costs, making it much more expensive, while also destroying the demand side because of the wealth effect that is only benefiting like a very few parts of this of the global economy. So ideally what you'd want is well, a company like this would want is to wait it out and wait for global economic growth. But yeah, I think this company could be doing better, just like the other examples, like iRobot or Hanes Brand, under lower rates and during good times in the economy and lower tariffs. So yeah, because even this part is struggling as well. It's not like everybody in this demographic is benefiting, but it's just the way the structure is right now, where the AI bubble kind of helps a lot of the wealth effect. Speaking of wealth effect as well, I do want to talk about something else that's been going on in my mind as well. One thing that's really good about Bitcoin is that you don't have to invest in it, but just to look at it for what it is. Like it seems that Trump can really impact the crypto markets along with the markets in general. And the government has always had the power to do this, which is why you can see like things like the Hong Seng crash tremendously because of like government intervention, whether it's from like Western government intervention or the Chinese government intervention, right? Like they can do it. It's not, I don't think it's difficult for them if they really try. And it can be done in numerous ways, but a lot of the types of holders in Bitcoin, cryptocurrencies, meme stocks, things like that, the AI bubble, it does create a lot of the wealth effect. And it's not like everybody who's benefiting from the wealth effect are all boomers. Like at this moment, with the way the job market is right now, you may want to create the wealth effect to act sort of like a UBI in a sense. But eventually, if you do lower interest rates and you do lower tariffs, there will probably be more need for labor to increase, the labor supply to increase. So a lot of the bubbles that have benefited boomers or certain demographics, if for example the primary holder of Bitcoin, I'm not saying it is, but if for example an asset is held heavily by labor, like the labor, like prime age laboring individuals, you may want to crash that asset just to like increase the labor supply. So like, let's just say, I'm not saying this is how it is, but let's just say like there's a lot of young folks from like the ages of like 16 to 40 who bought Bitcoin here and here, okay? Like between like 10,000 and like 20,000. Well, they benefited a lot, right? And if the federal interest rates are getting raised, so that means companies aren't doing too well because of all the monetary tightening, and so jobs and businesses close down. Yeah, you might want to have something like Bitcoin or the AI bubble or just like retail meme bubbles promote the wealth effect for these individuals. You may want to keep them, you may want to promote them into holding these things too and never selling or taking profits as well. And they'll feel like they're very rich on paper value, and you can sell them ideas that it's like a safe asset, even though it's not, in my opinion. And so, they'll be sitting happy, making like anywhere from 100 to 800% on their return on investment. But when you lower rates, or you decide to lower rates soon, when you want to lower tariffs, job openings will grow substantially. So you can crash these kind of assets in order to increase the labor supply for the prime working ages, right? So you're going to need more factory workers or more supply chain workers or more service workers as well, things like that. And you may not need it right now, but you will when you make economic changes. So I could see these asset bubbles crashing depending on the types of people who hold these assets as well. So I guess that's just my quick overview of like the AI bubble, interest rates, and tariffs. I haven't gone into like the trade dynamics and things like that specifically, but I think I will. Kind of just wanted to unstructuredly share whatever is on the top of my mind, and I'm not saying what I'm saying is right. Most of it's probably wrong, but it's just some of my opinions on things that I've had in mind. Just by a quick glance, right? Like, I haven't really sat down and said, well, let me do a lot of research on this to figure this out. It's just like, what would I do if I were, if I were in the position that, if I were the president or something, what would I do, right? So, I noticed that a lot of the global economy has generally been lowering interest rates, and honestly, you do want, for the most part, I think, to increase the global demand for goods and services, because it really does help a lot of the global economy and emerging markets too. It has to be done specifically, right? So we have things like the United Nations or APEC or economic cooperation organizations to do things, to have global economic developments done specifically to make sure that all stakeholders involved are benefiting from it, right? So like, no one's really left behind or things like that, right? Yeah, maybe I'll make some more videos that describe more of my views on things, but yeah, that was just my rambling. Probably gonna make another video explaining things a little bit better. I don't know. These are things I'm just thinking about. I guess too, I can share a little bit about why I've been so busy. So during this time of the year, I was very, very, very busy. And now in the past month or so, I've had some time to kind of, I was working like 50 to 70 hours a week or something. And I was also managing my my stock market, my stocks. So yeah, it was a hard time because I was working 50 to 70 hours a week while also managing my stock portfolios and things like that. And I invested heavily in the Hang Seng and a lot of Chinese companies around this time. So I think I was making a lot of videos at the time, mainly because I was trying to build convictions for my investments, and it's played out pretty well so far. But as you can tell, like, if you're working 50, 70 hours a week and you're also managing your portfolios, and then you have life obligations like family and things like that, like, you're just generally really busy. So I just haven't really had the time to think things through or talk about things. So I would love to go over a lot of things, like why haven't we had electric vehicles, or what adoption of electric vehicles means for like the internal combustion engine and oil economy and things like that. But that'll have to come. This is just like I don't know, I guess like a rambling video where I just ramble on about stuff. So I guess I'll end it for now, and we'll see. Maybe. Oh, that being said, I hope you have a good day. Thank you.